Property market with prices falling in major cities like Sydney and Melbourne, allowing buyers to secure some massive savings.
Last year saw that it was more of a buyer's market. There was a lot more choice, whereas this year it's really become more of a seller's market.
A debt crisis, a crime crisis, a housing crisis. Welcome to Victoria.
Here's what Victorian Premier Jacinta Allan doesn't want you to know. 5 Melbourne suburbs have crashed by double digits in the last 6 months. We're not talking minor corrections, we're talking catastrophic value destruction. And here's why the Premier is reportedly losing it in cabinet meetings. This isn't a national trend. This is Victoria-specific policy failure. While Perth and Brisbane are booming, Melbourne is in structural collapse, and it's about to get worse. In this video, I'm breaking down all 5 suburbs, the exact numbers, why each one crashed, and which suburbs are next on the chopping block. Let's get into it. Right, let's start with the absolute epicenter of this crash. Toorak. Toorak is Melbourne's most expensive suburb, the postcode that defines Melbourne wealth, and it just recorded a 25.4% annual decline in median house values. Let me put that in perspective. The median house in Toorak was worth approximately 4.5 million at the peak. A 25% drop means the median is now around $3.4 million. That's $1.1 million of equity evaporated. For a typical Toorak homeowner, that's more than most Australians will earn in their entire working lives. Gone. But here's where it gets even more brutal. The crash isn't uniform across all property types. 4-bedroom family homes, the core Toorak product, are down 31.9%, nearly 1/3 of value destroyed in the family home segment. So what's actually driving this catastrophic crash in Toorak? It's not mortgage stress. Toorak buyers don't typically struggle with repayments. It's tax-induced capital flight. The Victorian government's COVID debt repayment plan introduced what experts are calling the luxury surcharge. For Toorak mansions valued over $3 million, the annual land tax bill has increased by approximately $15,000 to $25,000 per year, depending on the property value. Now, for a family living in a $4.5 million Toorak home, that's an extra $20,000 plus per year in non-deductible expense, every single year, forever. The result? Discretionary sellers, often older empty nesters whose children have moved out, are choosing to exit rather than pay the tax. They're downsizing to suburbs without the luxury tax, or leaving Victoria entirely for Queensland's tax-free environment. But here's the problem. The buyer pool for $3 to $5 million homes has simultaneously thinned. Economic uncertainty, rising interest rates, reduced borrowing capacity. A family that could borrow $1.5 million in 2021 can now borrow roughly $1 million. In a market like Toorak, where properties start at $2 million, this removes the top tier of bidders entirely. To sell, vendors must meet the market where buyers can actually afford to transact. That means accepting 2025 borrowing capacity, not 2021 fantasy prices. Hence, the 25% crash. And here's the comparison that makes this even more striking. While Toorak crashes 25%, Perth's prestige suburbs are UP 15 to 20%. This is Victoria-specific policy failure, not a national luxury market correction. Next up, Moorabbin. And this crash tells a completely different story. Moorabbin house values have fallen 20.3% from their peak. Moorabbin saw an absolutely massive run-up in prices post-COVID. It was marketed as the affordable Bayside alternative to Brighton. Brighton, the prestige Bayside suburb, has median prices around $3 million plus. Moorabbin, just a few kilometres away, was hitting 1.2 to 1.4 million odd at the peak. The pitch to buyers was simple. Get Bayside living without the Brighton price tag. And for a while, it worked. Families priced out of Brighton flooded into Moorabbin, driving prices up 40 to 50% between 2020 and 2022. But here's what those buyers didn't realise. Moorabbin isn't actually Brighton. It lacks the pure residential character. It's industrial adjacent. It doesn't have the same school zones. It doesn't have the scarcity value. Moorabbin was a speculative play based on Bayside premium pricing. And when the market turned, all that speculative froth got blown off immediately. The 20% crash represents a brutal revaluation back to fundamentals. But there's another factor making Moorabbin's crash worse: the upgrade freeze. Moorabbin is typically a stepping stone suburb. Young families buy there with the intention of upgrading to Brighton or Sandringham in 5 to 7 years. But with borrowing capacity down 30% and Brighton prices still elevated, that upgrade pathway is blocked. Families who bought in Moorabbin in 2021 thinking they'd upgrade by 2026 are now trapped. They can't afford to move up, and if they try to sell, they're taking a $200,000 to $300,000 loss. This creates what economists call a liquidity trap. Properties sit on the market for months because sellers refuse to accept the new reality. While Moorabbin crashes 20%, Adelaide's beachside suburbs, Glenelg, Brighton SA, are up 8 to 12%. Again, this is Victoria-specific collapse. Suburb 3, Flemington, down 17.3% from peak. Flemington is the perfect example of what I call gentrification reversal. Let me explain. Flemington spent the last decade being aggressively gentrified. Old, unrenovated Victorian cottages were being snapped up by young professionals, renovated into Instagram-worthy homes, and flipped for profit. At the peak, even unrenovated Flemington cottages were selling for $800,000 to $900,000, based purely on renovation potential. But that entire model has collapsed. And it collapsed for one simple reason: renovation costs. A renovation that cost $300,000 in 2020 now costs $450,000. And it takes 18 months instead of 12 because of trade shortages and supply chain issues. So, when a buyer looks at that unrenovated Flemington cottage, they're no longer seeing potential. They're seeing a money pit. They calculate, if I buy this for $800K and spend $500K renovating, I'm all in for $1.3 million. But comparable renovated homes are selling for $900K. The math doesn't work, so they discount the unrenovated property heavily, or they don't buy at all. But there's a second factor destroying Flemington: the investor strike. Flemington has a high concentration of investment properties, Victorian-era homes bought by landlords who rent them out. These properties are typically older, high maintenance, and now subject to Victoria's new land tax regime. For a typical mum and dad investor holding a $600,000 Flemington cottage, the holding costs have become unsustainable. They are now facing monthly mortgage interest payments of $2,500, on top of a new $1,500 annual land tax bill and $3,000 in maintenance for an aging home. When you add property management fees taking another 7 to 8% of the rent, these investors are effectively bleeding cash every single week. Meanwhile, the rental yield, around 3.5% gross. After all costs, they're negatively geared and losing money every month. The decision is simple: sell and exit Victoria. And that's exactly what's happening. Flemington listings have surged, flooding the market with supply at exactly the time when buyer demand has collapsed. Flemington's 17% crash compares to Newcastle's gentrifying suburbs, Islington, Hamilton, which are up 5 to 8%. Same gentrification story, opposite outcomes. Suburb 4, Malvern East, down 16.5% annually. Malvern East is what property analysts call a spillover suburb. Let me explain the dynamics. In a normal market, buyers who can't afford Toorak or Malvern, the prestige originals, spill over into Malvern East. It's the affordable prestige play. But here's what's happening now. Toorak is crashing 25%. When Toorak drops 25%, it suddenly becomes relatively cheaper. A family that was forced to look in Malvern East in 2021 can now afford to look back in actual Malvern or even Toorak. This sucks demand away from the spillover suburbs. Buyers return to the original prestige areas now that they're on sale. The result? Malvern East gets squeezed from both sides. From above, Toorak, Malvern become relatively affordable, stealing buyers from below. Cheaper suburbs offer better value for money, and when demand disappears, prices collapse. The median Malvern East home has lost approximately $450,000 in value. For homeowners, this is psychologically devastating. That's not just paper wealth. That's retirement plans destroyed, kids' university funds gone, and decades of equity evaporated. The negative wealth effect cannot be overstated. When homeowners in Malvern East feel $450,000 poorer, they cut spending. They don't renovate. They don't buy new cars. They don't eat out. This ripples through the local economy. Retail strips in Malvern East see declining foot traffic. Restaurants close. The suburb enters a doom loop. While Malvern East crashes 16.5%, Sydney's inner east equivalents, Woollahra, Paddington, are down only 2 to 4%. Melbourne's correction is 5 times deeper than Sydney's equivalent suburbs. And here's the political dimension. Malvern East is in a marginal seat. These are voters who feel betrayed by Labor's policies. The Victorian Premier is dealing with a furious electorate watching their life savings evaporate while the government celebrates stamp duty revenue increases. This is why the Premier loses it narrative has traction. The political pressure is immense. Suburb 5, Melbourne, CBD. Suburb 5, and this one's different. Melbourne, CBD, down 16.1%. But the negative 16.1% doesn't tell the full story. The CBD isn't crashing because of tax policy or mortgage stress. The Melbourne CBD is experiencing what the research report calls a market failure. Let me explain what this means. Between 2024, developers built tens of thousands of high-rise apartments in the CBD, Docklands and South Bank. These were sold off the plan, meaning buyers signed contracts before construction even started. The pitch was simple: buy now, make capital gains by completion. But between contract signing and completion, 3 things happened. Problem 1, bank valuations collapsed. If the buyer signs a contract for a $600,000 apartment in 2021, construction finishes in 2024. They go to the bank for final loan approval. The bank values it at $500,000. The buyer needs to bring $100,000 cash to settle just to cover the valuation shortfall. Most can't. So the contract falls through. Problem 2, foreign buyer exodus. The Victorian government increased foreign purchaser duty to 8%, one of the highest in Australia. For a $600,000 apartment, that's $48,000 in additional tax. This decimated demand from international buyers, who were the primary market for these investor-grade shoeboxes. Problem 3, build quality scandals. High-profile defects in towers like Opal Tower, Sydney, and various Melbourne buildings have permanently damaged confidence in high-rise living. Buyers are terrified of buying apartments that might have structural issues or cladding problems. The result of these 3 factors? 8,000 completed apartments sitting unsold. Developers are holding on to this stock hoping for a recovery, but every single month they wait, they're bleeding cash on 7 to 8% construction loan interest. On top of that, they face annual body corporate fees of up to $6,000 per unit and thousands in council rates. This leaves billions of dollars tied up in non-performing assets, creating a massive opportunity cost as these empty units continue to drain capital. And here's the cruelest twist, the negative equity trap. Many investors who bought CBD apartments 5 to 10 years ago are now underwater. Example, investor bought Docklands apartment for $550,000 in 2015. In 2025, comparable sales show $500,000 or less. After 10 years, the asset has lost value. They're trapped. They can't refinance because their loan-to-value ratio is above 80%. They can't sell without taking a loss. They're what the industry calls mortgage prisoners, paying 6.5% interest on a depreciating asset with no exit strategy. The rental paradox. Despite 8,000 unsold apartments, rents are soaring. CBD median rent, $650 week. Why? Because the unsold stock isn't entering the rental pool. Developers are holding it empty, or it's held by overseas owners who don't lease it out. Simultaneous oversupply for sale and undersupply for rent. Classic market failure. Melbourne CBD is down 16%. Brisbane CBD apartments are up 5 to 8%. Same product type, opposite trajectories. The difference? One market has confidence. The other has 8,000 unsold units, destroying sentiment. So, we've covered 5 suburbs, 5 different crash stories. But there's one common thread, Victorian government policy. Let me break down the 4 policy failures driving this crisis. Failure 1. The land tax war. By dropping the threshold from $300,000 to $50,000, the government brought previously exempt properties into the tax net. For a typical investor with a $600,000 property, that's $1,200 to $1,500 per year in new costs. When yields are already thin at 3 to 4%, this destroys the investment case. The result? Investor exodus. Over 21,000 rental properties disappeared from the Victorian market in the last financial year. Failure 2. The apartment oversupply. Victoria approved and constructed a massive wave of high-density apartments between 2018 and 2023. The government failed to coordinate supply with demand. They approved every tower application, assuming endless foreign buyer appetite. When foreign buyer duties increased to 8% and international students declined, demand evaporated, but supply kept coming. Failure 3. The mortgage stress belt. In suburbs like Malvern East, Clyde North, Melton, Wyndham Vale, dominated by first home buyers, mortgage stress is epidemic. These buyers purchased with 2% fixed rates in 2020-2021. As those rates expired to 6.5%, monthly repayments nearly doubled. Many can't afford the new payments. Forced sales are increasing, and when one distressed seller accepts $50,000 below market to get out fast, it resets the benchmark for the entire suburb. Failure 4. The war on councils. Premier Jacinta Allan is threatening to strip local councils of planning powers because the state is missing its housing targets. But here's the reality. Councils aren't the bottleneck. Financial viability is the bottleneck. Developers are sitting on approved permits they won't build because construction costs, up 30%, and interest rates make projects unprofitable. The Premier's response, centralising planning power, is political theatre, not a solution. And when political theatre meets economic reality, you get a Premier losing it in cabinet meetings as the crisis worsens. So, which suburbs are next on the chopping block? Tier 1 suburbs like Brunswick West and Carlton are already seeing listings surge and vendors slashing prices just to exit. Tier 2 is the mortgage stress belt in the outer growth corridors, where the 2025 fixed-rate cliff is set to trigger a wave of forced sales. And Tier 3 If developers are forced to liquidate those 8,000 unsold apartments in Docklands, it won't just hurt, it will crater the entire inner city market. Here's the truth. 5 Melbourne suburbs have crashed by double digits. Toorak down 25%, Moorabbin down 20%, Flemington down 17%, Malvern East down 16%, CBD down 16%. This is Victoria-specific policy failure. While Perth and Brisbane boom, Melbourne burns. I'll be covering every suburb, every data release, every policy disaster. Subscribe to Aussie Explained so you don't miss the next video where I'll break down which outer suburbs are heading for foreclosure waves in 2026. Thanks for watching. See you in the next one.